as we continue this audiobook and video training series based on my book, Forex Trading Fundamentals, A Complete Beginner's Guide. If you've been following along from Chapter 1, you already have a solid foundation of what the Forex market is, how it evolved, and who the key players are. Now it's time to move one level deeper, into the core of how the market actually functions. Welcome to Chapter 2, Currency Pairs and Market Mechanics. This chapter will help you understand how currencies interact with one another. Because in Forex, you're never buying or selling a single currency in isolation. Every transaction involves a pair, and knowing how those pairs work is the secret to reading the market confidently. Here's what we'll cover in this chapter. Keycap 1 Session 2.1 Base and Quote Currency Explained. We'll break down what those two sides of every pair mean, how exchange rates are calculated, and how profit or loss is measured. Keycap 2 Session 2.2 Major, Minor, and Exotic Pairs. You will learn how different currency groups behave, which pairs are best for beginners, and why liquidity matters so much to your cost and success rate. Keycap 3 Session 2.3 How exchange rates are quoted. Here we'll dive into direct versus indirect quotes, bid-ask pricing, and how to interpret exchange rates the same way professionals do. Keycap 4 Session 2.4 Spreads, Pips, and Leverage. Finally, we'll unpack the practical mechanics, what a pip really is, how spreads affect your trades, and how leverage can either accelerate profits or magnify losses. By the end of Chapter 2, you'll understand exactly how prices move, how to measure those moves, and how to manage your positions with precision and confidence. Before we get started, I want to remind you to subscribe to TheRockFXHub, like this video, and share it with anyone who's serious about learning how to trade. That way, you'll get a notification every time I upload a new chapter, and you can keep learning in sequence without missing a step. So, grab your notebook, stay focused, and let's dive straight into the heart of the market. Welcome to Chapter 2, Currency Pairs and Market Mechanics. Section 2.1, Base and Quote Currency Explained. Page 1. In the realm of Forex trading, you never deal with a single currency in isolation. You always trade currency pairs, understanding the first fundamental concept. The base currency in the quote or counter currency is essential. A currency pair is written in the form XXX/YYY, where the first currency XXX is the base currency and the second YYY is the quote currency. For example, in the pair euro to US dollar, euro is the base currency and USD is the quote currency. The exchange rate for a pair tells you how much of the quote currency is needed to buy 1 unit of the base currency. If euro to US dollar equals 1.1500, it means 1 euro could be exchanged for 1.15 US dollars. The base currency is therefore the unit you are buying if you go long, while the quote currency is what you give up in return. Why is this important? Because when you place a trade, you are effectively saying, I believe the base currency will strengthen or weaken against the quote currency. If you buy euro to US dollar, you're buying euro and selling USD. If you sell euro to US dollar, you're selling euro and buying USD. This convention shapes how you interpret price movements. A rising euro to US dollar means a euro base is gaining relative to the dollar quote. A falling rate means a euro is weakening or the dollar is strengthening. Mesero. Many beginners find the concept intuitive, but it remains a foundation that traders build on for position sizing, risk, and profit calculation. A clear understanding of base and quote currencies also helps you interpret the platform's pricing, avoid confusion when looking at pair notation, and compare pairs logically. In the next section, we'll explore how quote conventions differ across regions and how quoting style can influence your perception of a trade. Page 2. The mechanics of base and quote currencies go deeper when you consider quote conventions and regional practices. According to the Chicago Fed's Guide to FX quote conventions, the first currency in the notation is called a named or base currency, and the second is a terms or quote currency. CME Group, for example, in euro to US dollar, euro is the named or base currency, and USD is the terms or quote currency. Quote conventions can differ by region. Some currencies are quoted in American terms. USD is a base currency, while others use European terms. USD is a quote currency. This matters when you compare pairs like US dollar to Japanese yen, USD base, JPY quote, versus euro to US dollar, euro base, USD quote. The positioning of a USD influences perception of which currency you are effectively trading. Another key point, the base currency always has a value of 1 unit. The exchange rate then indicates how many units of quote currency are needed. For example, in pound sterling to US dollar equals 1.3000, 1 British pound base costs 1.30 US. From a practical perspective, you buy the pair when you expect the base currency to strengthen or the quote to weaken. You sell the pair when you expect the base currency to weaken or the quote to strengthen. It's a reflection not simply of one currency's movement, but the relationship between two. Understanding that relationship is what separates amateur guessing from informed trading. Now that you understand base/quote definitions and convention, the next step is to learn how this affects profit and loss calculation, pip value, and how your account currency interacts with the quote currency. That is where many new traders stumble. Page 3. Let us now turn to practical implications of base and quote currencies for the trader, namely, how they impact position size, profit/loss calculation, and account currency alignment. When you open a trade on euro to US dollar, you are effectively buying euro and selling USD. Your profit or loss will be reflected in the quote currency, USD in this case. So if you bought euro to US dollar and it moved from 1.1500 to 1.1600, that gain of 100 pips means a euro increased in value versus a dollar, and your profit would be in US dollar. Importantly, your account currency may differ from the quote currency. For example, if your brokerage account is denominated in GBP but you trade euro to US dollar, quote in USD, any profit in USD will be converted to GBP, introducing currency conversion risk. Understanding base/quote helps you anticipate those extra variables. The concept of pip value also hinges on the quote currency. In a pair where USD is a quote currency, a standard lot, 100,000 units of base, often yields $10 per pip move, assuming typical pricing. If the quote currency is not USD, you must convert the pip value into your account currency. Finally, base/quote currency matters for risk management. Suppose you intend to risk 100 pounds on a trade, but you're trading a pair quoted in USD. You must calculate how many units you can take so that a stop loss of e.g. 50 pips translates to 100-pound risk, factoring in US dollar to pound sterling conversion. This level of precision separates structured traders from casual ones. Thus, base and quote currencies are not just definitions. They shape how you trade, how you calculate risk, how you interpret profit, and how you manage your account. With these mechanics in mind, the next section will show how pair categories, majors, minors, exotics, further affect liquidity, spreads, and trading cost. Page 4. The category of the currency pair, whether it's a major, minor, cross, or exotic, is directly related to which currency sits in the base and which sits in the quote, and this impacts trading cost and liquidity. According to Investopedia, major currency pairs involve the US dollar in either the base or quote position and are the most liquid. For example, euro to US dollar, euro base, USD quote, or US dollar to Japanese yen, USD base, JPY quote, are majors. In these cases, a quote currency is either USD or another major currency with high liquidity, which typically means tighter spreads and better execution for retail traders. Cross-currency pairs or minors exclude the USD, e.g., Euro to Pound Sterling, AUD/NZD. While both currencies are major economic units, because neither is the U.S. dollar, the depth of liquidity can be lower and spreads wider. This is a direct consequence of where you find the quote currency and how much volume is traded in that position. Exotic pairs pair a major currency with a currency from an emerging or smaller economy, e.g., USD/ZR, USD/TRY. The quote currency in these pairs may be less liquid, less stable, and more volatile, leading to wider spreads and increased cost of trading. The base/quote dynamic matters here because if the quote currency is weak or unstable, your trade cost and execution risk can increase. What this means for you as a beginner. When you start trading, focus on pairs where the quote currency is stable and liquid, often USD, because that simplifies execution, pip value calculation, and risk control. It also simplifies assessing base/quote conventions without the complication of exotic currencies or less tradable quotes. In short, the base/quote relationship ties into broader pair classification, which in turn informs cost and strategy. Next, I will show how base and quote currencies affect spread, leverage, and margin requirements. All key trading mechanics. Page 5. To summarize this section, understanding the base currency, first listed, and the quote currency, second listed, is a cornerstone of Forex trading. The exchange rate shows how much quote currency you need to buy 1 unit of the base currency. Knowing this equips you to read quotes correctly, interpret price changes, and decide on positions with clarity. From a trading mechanics viewpoint. 1. You buy the pair if you believe the base currency will strengthen against the quote currency. You sell if you believe the base will weaken. 2. Your profit or loss is denominated in the quote currency and may need conversion if your account uses a different currency. 3. Pairs with liquid stable quote currencies like USD simplify execution, pip value, and risk calculation. 4. Less liquid quote currencies and exotic pairs increase cost, widen spreads, and require greater caution. Mastering base/quote mechanics bridges the gap between surface knowledge and applied trading. Before moving on, ensure you can 1. Identify base and quote currencies in any pair. 2. Convert trades pip movement into your account currency. 3. Recognize how pair classification relates to base/quote liquidity. In the next chapter subsection, we'll dive deeper into major, minor, and exotic currency pairs, building on today's foundation, so you can choose your trading universe with intent and confidence. Section 2.2. Major, minor, and exotic pairs. Page 1. When diving into the currency pair universe of the Forex market, you will encounter 3 broad classifications: major, minor, or cross, and exotic pairs. Understanding these categories is critical because they influence liquidity, trading cost, spread, volatility, and the overall strategy you may apply. According to FX Educational Resources, these groupings are based on how commonly the pairs are traded, which major economies are involved, and whether the U.S. dollar USD features in the pair. Let's begin with the major currency pairs. These always include the U.S. dollar on one side of the pair and a currency from another major global economy on the other. For example, Euro to U.S. dollar, Euro/U.S. dollar, U.S. dollar to Japanese yen, U.S. dollar/Japanese yen, Pound sterling to U.S. dollar, British pound/U.S. dollar, and so on. These pairs dominate the trading volume. One source indicates that euro to US dollar alone accounts for about 30% of all FX volume. Major pairs are favored by both retail and institutional traders because they are characterized by high liquidity, meaning lots of buyers and sellers are active at any moment. That leads to tight spreads, modest slippage, and generally more predictable price action. For a beginner, this means lower cost and simpler execution. Important foundations for learning. However, because so many traders are active in these major pairs, the competition is intense. You are trading where many others are too. Hence, while major pairs are ideal for beginners, the real edge arises through discipline, process, and risk management rather than simply picking them. Page 2. Moving beyond majors, we come to the minor currency pairs, often called cross-currency pairs. These are pairs that do not include the US dollar. Instead, they pair two other major currencies. Examples include euro to pound sterling, euro/British pound, euro to Australian dollar, euro/Australian dollar, pound sterling to Japanese yen, British pound/Japanese yen. Miners offer interesting alternatives for traders who either want to avoid USD-driven pairs and the associated US, economic and policy noise, or who seek diverse behavior patterns. For example, euro to Japanese yen or pound sterling to Japanese yen often offer stronger trends or carry trade opportunities due to differences in economic cycles between Europe/UK and Japan. But miners come with trade-offs. Their liquidity is generally lower than the majors, meaning spreads may be wider and execution may occasionally suffer. This raises cost and risk. For a beginner trader, that means increased attention must be paid to cost and position sizing. The additional advantage is that minor pairs might offer opportunities less crowded than the majors, less competition, but require more care. In practice, a good approach is to start with major pairs because of their simplicity and liquidity. And then, once you understand mechanics and risk, gradually explore cross-currency pairs to diversify and sharpen your edge. That diversification helps you avoid being overly tied to USD-centric moves and allows you to gain exposure to other economic relationships. Page 3. Finally, we arrive at the most dynamic and riskiest category: exotic currency pairs. An exotic pair combines a major currency, like USD, Euro, GBP, JPY, with a currency of smaller or emerging market economy, such as TRY, Turkish lira, ZR, South African rand, MXN, Mexican peso, INR, Indian rupee. These exotic pairs offer potential advantages. Because liquidity is lower, price movements can be more dramatic, presenting opportunities for larger moves. They can capture structural changes in emerging economies, commodity flows, or regional policy shifts that may not be fully priced in. For a trader willing to accept risk, exotics can be useful additions. However, the trade-offs are significant: wider spreads, higher slippage, lower transparency, and often higher volatility. For example, USD/TRY may respond sharply to Turkish political events or monetary policy shifts. The same move in a major pair might be muted because of better liquidity and depth, but the higher return potential comes with correspondingly higher risk. Especially for a beginner, use the tighter spread majors. Many FX educators caution that exotic pairs are not beginner-friendly and must be approached only after mastery of the basics. For your trading strategy, this categorization matters. Liquidity affects cost, time frames, and risk buffers. For example, a scalping trade works best in a major pair with tight spread. A swing trade might use a minor pair looking for larger trend. An exotic might be reserved for a speculative event trade with small position size and high risk control. Understanding this helps you choose your trading universe intentionally rather than randomly. Page 4. Let's summarize how the categories differ side by side and how you might apply them as a trader. Majors: highest liquidity, tightest spreads, strong global reporting and analysis, best for beginners. Example: Euro to US dollar to Japanese yen, pound sterling to US dollar. Minors: cross is good alternatives once you're comfortable, moderate liquidity, spreads slightly wider, interesting behaviors outside USD. Example: Euro to pound sterling to Japanese yen. Exotics: most volatile, highest cost, potentially high returns but high risk. Use only with strong risk management. Example: USD/ZR, Euro/TRY. As a beginner, you might start by focusing on 2 or 3 major pairs for your trading style: day trading, swing, etc. Track session times, spread behavior, and news impact on those pairs. As you build comfort, incorporate 1 or 2 minor pairs for diversification, and only consider exotic pairs when you have consistency, discipline, and risk controls locked in. Lastly, always remember, pair classification isn't just academic. It matters for your trading mechanics. Lower liquidity equals wider spreads equals more drag on your profitability. Higher volatility equals greater profit potential but greater risk. Execution costs, risk sizing, psychology, and trading style should all align with the category of pairs you trade. With this foundation in place, you're ready to move next into Section 2.3, how exchange rates are quoted, where we'll examine quoting conventions, direct versus indirect quotes, and how to interpret